Thank you for your time today. What we're going to do is look at the settings page and the changes that have been made to it. And also we're going to look at estate administration taxes. So specifically on settings, in the past we worked with an individual primary account only, one for Bill, one for Sue. If, for instance, we go to the entries tab, we can see, of course, on Bill's tab under portfolio accounts that he has a primary account. He also has a non-registered portfolio. And then if we go to solutions, tactics, what we'll see is that any excess cash that Bill might have automatically, in this case, is being contributed to his non-registered portfolio. So let's go back to entries for a minute. What we're going to do is just exclude Bill and Sue's non-reg portfolios. We're going to work instead, in this case, with a joint non-reg portfolio. By the way, there's nothing that prevents Bill and Sue from having as many individual non-registered portfolios as they want, and similarly, joint non-registered portfolios. But for our purposes today, I want to just work with the single joint non-registered portfolio. So if we go back to settings, I can now switch to a joint primary account. And I want you to notice the 50-50 here because it is joint. So all cash sources for both flow into it. All cash uses are paid on a 50-50 basis from the joint account. So let's go to entries, the joint portfolio, and we can see now there's a joint primary account and a joint non-registered portfolio. Similar to the individual non-registered portfolios, any excess cash is now going to go into the joint non-reg portfolio. I want you to notice that current ownership has in brackets financial interest. So there is a difference between the legal ownership, let's say joint tenant with right of survivorship on a 50-50 basis, and the financial interest. So what I'm going to do to illustrate this is change the relative financial interest to 70-30. And then also what I'm going to do is I'm going to add $200,000 to the portfolio, and I'm going to assign it a 2% interest return, so that we're talking about $4,000 of annual interest income. If we look now at net cash flow and we have a look at taxes, what we'll see is that for Bill's taxes, $2,800 of interest is being earned. In other words, the $4,000 of total interest times his 70% interest, financial interest in the joint account. And then similarly, of course, for Sue, it would be the $4,000 times her 30% financial interest, which would be $1,200. The important thing to understand about this is that this is being done because of attribution rules. Attribution rules are the reasons that there are things like spousal loans for investments and spousal RSPs. So it's important, even though an investment account may be joint, that there is this continuing allocation of portfolio returns based on the financial interest in the account. And what VisionWorks does on a go-forward basis is it actually tracks this every year based on relative net contributions that go in to the plan. The other thing I wanted to do today was look at the revisions to estate administration taxes. So if we go back to the About page, you'll see that Bill and Sue are both residents of Alberta. And in this particular plan, Bill has a cottage. So let's assume again the divorce scenario where in his breakup with his former wife, she took the house, he took the cottage, so it's his asset. If we go down to solutions, what you can see under estate for Bill and estate administration taxes is that they're just $525, which applies to any estate in Alberta, which is $250,000 or more. However, let's assume for a moment that the cottage is actually located in BC. So we can go to the Will tab, the cottage, open the beneficiaries panel, and you'll notice now that there's a new entry for location. And this just applies to secondary residences, rental properties, and business buildings for the self-employed business person. It doesn't apply to a primary residence. We assume that's in the province where you live. And it doesn't apply to things like art. We assume that that's in your primary residence. So what I'm going to do is I'm just going to change the location to BC. And what that means is that the cottage, the estate administration taxes that will be calculated on it are based on BC estate administration taxes, and then everything else for Bill is based on Alberta. So if we go back now to solutions and we have a look at the estate output for Bill, what we'll see is that the $525 is now $31,000 based on the projected value of the BC cottage at the time of Bill's death. So that's a significant enhancement in the accuracy of doing estate administration taxes. Those are the two things that I wanted to discuss today. If you have any questions about them, by all means, please give me a call, and thank you for your time.